Welcome back. Today we will look at 20 important questions related to Chapter 3 of Securities Markets and Financial Instruments. This quiz will help you strengthen your concepts for finance and NISM exam preparation. You can pause after each question and take your time to answer before the solution appears. Let's test your understanding. Try answering before the explanation begins. Okay, let's jump right into Section 1, Equity Market Fundamentals. We're going to set a nice, focused pace here to tackle some of these core equity terms first. Question 1. What is the face value of a share? Is it A, current market price, B, nominal value of the share, C, intrinsic value, or D, replacement value? Pause now if you need more time. All right, the correct answer is option B, nominal value of the share. You know, face value really serves as the absolute baseline. It's just the nominal value assigned by the company when they issue shares. And it's super important because it's used to calculate the company's total share capital and figure out the exact amount of dividends to pay out to shareholders. Moving on to question 2. Market capitalization is calculated as A, face value multiplied by shares, B, net profit multiplied by EPS, C, market price multiplied by outstanding shares, or D, assets minus liabilities. Pause now if you need more time. The correct answer here is option C, market price multiplied by outstanding shares. So the main takeaway is that market cap represents the total current market value of the entire company. It literally reflects what the financial markets collectively believe the business is worth on any given day. Let's look at question 3. EPS stands for A, equity price share, B, earnings per share, C, equity profit standard, or D, estimated profit share. Pause now if you need more time. The correct answer is option B, earnings per share. This is a brilliant way to illustrate a company's profitability. EPS measures the exact amount of net profit earned for each individual outstanding share. Basically, a higher EPS usually points to much better profitability and earnings potential for you, the shareholder. Question 4. Debt investors primarily earn A, voting rights, B, fixed interest, C, residual profits, or D, ownership benefits. Go ahead and pause now if you need more time. Okay, the correct answer is option B, fixed interest. Let's remember the core difference between our asset classes here. Debt investors are lenders to the business, right? They aren't owners, so they don't get voting rights or a slice of the residual profits. Instead, they get a fixed coupon, or interest, along with the repayment of their principal at maturity. Question 5. Intrinsic value refers to A, current market price, B, discounted future cash flows, C, face value of share, or D, historical cost. Pause now if you need more time. The correct answer is option B, discounted future cash flows. Simply put, intrinsic value is just the estimated true worth of a business. We calculate it by projecting the future expected cash flows of the asset and then discounting them back to what they'd be worth today, their present value. Question 6. A stock is considered undervalued when A, market value is greater than intrinsic value, B, intrinsic value is greater than market value, C, face value is greater than market value, or D, book value equals market value. Pause now if you need more time. The correct answer is option B, intrinsic value is greater than market value. This is exactly what value investors are actively searching for. If the true estimated worth of the stock, its intrinsic value, is higher than what it's currently trading for in the market, well, it's considered a bargain. It's undervalued. Question 7. Enterprise value represents A, only equity value, B, only debt value, C, total value of business operations, or D, net profit of company. Pause now if you need more time. And the correct answer is option C, total value of business operations. Enterprise value really gives you the whole picture. It's calculated by taking the market capitalization, adding the total debt, and then subtracting cash. We subtract the cash because if you were buying the company, that cash would actually reduce your effective acquisition cost. That's why enterprise value is so often referred to as the takeover value. Question 8. Which statement regarding PE ratio is correct? A, high PE always means overvalued. B, low PE always means undervalued. C, PE reflects future growth expectations. Or D, PE ignores earnings completely. Pause now if you need more time. The correct answer is option C, PE reflects future growth expectations. This is such a vital concept in equity markets. The price-to-earnings ratio shows what investors are willing to pay today for future growth. So a high PE doesn't always automatically mean a stock is overvalued. Sometimes it just means the market expects massive earnings growth down the line. Question 9. P/BV ratio below 1 may indicate A. Stock is definitely profitable, B. Stock may be undervalued, C. Company has no liabilities, or D. Market price equals book value. Pause now if you need more time. The correct answer is option B. Stock may be undervalued. Now be a little careful here, because this is a classic exam trap. A price to book value below 1 just means the market price is lower than the accounting book value. So while it might indicate undervaluation, it could also signal that the company has poor business quality, some hidden risks, or maybe toxic assets on its balance sheet. Question 10. DVR shares are mainly issued to A. Increase debt, B. Avoid paying dividends, C. Raise funds without losing control, or D. Eliminate shareholders. Pause now if you need more time. The correct answer is option C. Raise funds without losing control. DVR actually stands for differential voting rights. These specific shares carry fewer voting rights than regular common shares. That makes them highly attractive for promoters who want to raise fresh capital but absolutely do not want to dilute their management control over the company. Awesome. Great job completing the first half. Let's transition into Section 2, Debt and Commodity Markets. Here, we're going to shift our focus over to bond features, yield calculations, and some commodity pricing dynamics. Let's keep that great focus going. Question 11. Bond prices and market interest rates are A. Directly related, B. Inversely related, C. Always equal, or D. Unrelated. Pause now if you need more time. The correct answer is option B. Inversely related. Honestly, this is the absolute golden rule of debt markets. When market interest rates rise, newly issued bonds offer higher yields. That makes existing, lower-yielding bonds a lot less attractive, so their prices fall. And it works the other way too. When rates fall, older, high-coupon bonds become way more valuable, driving their prices up. Question 12. Yield to maturity, or YTM, considers A. Only coupon income, B. Only redemption value, C. All future bond cash flows, or D. Only market price. Pause now if you need more time. The correct answer is option C, all future bond cash flows. Think of YTM as effectively the internal rate of return for a bond. It's a really comprehensive metric that encompasses everything: the periodic coupon payments, the income from reinvesting those coupons, and the final redemption value you get at maturity. Question 13. Current yield is calculated as A. Coupon divided by market price, B. Market price divided by coupon, C. Coupon divided by face value, or D. Price divided by EPS. Pause now if you need more time. The correct answer is option A, coupon divided by market price. While this is super simple to calculate, it's really important to know its limitations. Current yield completely ignores capital gains or losses, and it ignores reinvestment income, which is exactly why yield to maturity is usually considered a far superior metric for bond investors. Question 14. Duration measures. A. Company profitability, B. Weighted average recovery time of investment, C. Dividend payout ratio, or D. Equity growth rate. Pause now if you need more time. The correct answer is option B, weighted average recovery time of investment. This metric is hands down the best way to understand a bond's overall risk profile. Duration essentially tells us how sensitive a bond's price is to changes in market interest rates. A higher duration just means higher interest rate risk and a greater potential for price fluctuation. Question 15. Zero coupon bonds generate returns through A. Quarterly dividends, B. Periodic coupon payments, C. Discount and redemption difference, or D. Equity appreciation. Pause now if you need more time. The correct answer is option C, discount and redemption difference. As the name explicitly states, zeros pay absolutely no periodic interest or coupons. Instead, they're issued at a steep discount to their face value and then redeemed at par value upon maturity. So your return is quite simply the difference between the discounted purchase price and the final redemption value. Question 16. Floating rate bonds reduces A. Credit risk, B. Interest rate risk, C. Liquidity risk, or D. Equity dilution. Pause now if you need more time. The correct answer is option B, interest rate risk. Because the coupon rate on these specific bonds isn't fixed, but instead resets periodically to match a market benchmark like interbank rates, the bond's price stays relatively stable. This constant adjustment directly minimizes your exposure to interest rate fluctuations. Question 17. Convertible bonds combine features of A. Equity and debt, B. Debt and commodities, C. equity and futures, or D, debt and insurance? Pause now if you need more time. The correct answer is option A, equity and debt. These are really fascinating instruments. They start their life as traditional debt, usually offering a lower coupon rate to the issuer, but they give the investor the distinct option to convert that debt into equity shares later on. That lets you capture the potential upside of the company's stock growth. Question 18. Masala bonds transfer currency risk to A, issuer, B, government, C, investor, or D, RBI. Pause now if you need more time. The correct answer is option C, investor. Masala bonds are Indian rupee denominated bonds that are issued in foreign markets. Because they're denominated and settled in rupees, if the rupee happens to depreciate against the foreign investor's local currency, the investor receives lower returns. Therefore, the foreign investor completely bears the currency risk, not the Indian issuer. Question 19. Perpetual bonds. A, have fixed maturity. B, never mature. C, pay no coupon. Or D, are equity instruments. Pause now if you need more time. The correct answer is option B, never mature. Perpetual bonds genuinely have no stated maturity date. The issuer has absolutely no obligation to ever redeem the principal amount, but they do pay coupons indefinitely. They're frequently used by banks in India and globally to raise additional Tier 1 or AT1 capital so they can meet strict Basel III regulatory requirements. Question 20, our final question. Contango occurs when A, spot price is greater than futures price, B, futures price is greater than spot price, C, spot price equals futures price, or D, futures market collapses. Pause now if you need more time. The correct answer is option B, futures price is greater than spot price. Stepping into the commodity markets for a second, Contango reflects a situation where the forward or futures price is higher than the current spot price of the underlying asset. This is usually driven by the cost of carry, which includes real-world costs like storage, insurance, and financing over time. Which kind of makes you wonder, if physical storage costs disappear entirely in a digital world, how will Contango apply to purely digital assets? Definitely something to think about. Great job completing these Chapter 3 questions. Keep practicing consistently to strengthen your understanding of securities markets and financial instruments. See you in the next quiz session.